Welcome back to the Mining Pod. We got Dylan LeClair on the show. Dylan, you are fresh off a hot tweet and you're getting pummeled online, being called a pigeon, among other things. Welcome to the show. I'm excited to dive into it. It's a really immaculate timing.
Yeah, I'm excited to be here, Will. Definitely good timing to be on a mining pod.
Yeah. So for those who are not on Twitter, Dylan went out and gave his thoughts on Bitcoin tail emissions. I'll let you summarize it. I guess we could possibly play the video in a second here, but I'll let you summarize it.
Yeah, I mean, the core of the argument is, Bitcoin right now and, throughout its history is, its miner compensation model has been predominantly block subsidy, right? New coin issuance entering circulation. That, that total supply is kind of like on an asymptote. So right now, 19.5 million Bitcoin, there will only ever be 21 million. And with each having that miner issuance gets cut in half. So the thought, the debate, the topic at hand is, well, in X amount of halvings, Bitcoin's going to become insecure. It's going to, the threat is that it becomes trivial to attack the network. And what does that attack look like? Well, a 51% attack, aside from, I guess, well, the double spend is one, right? Where, I'm a miner, I send you coins, I reorg, I basically rewrite that transaction, and the coins you thought you had, you don't have. The other ones are, say this is like a state actor of sorts. Never mind the fact that, this is assuming that 51% of there's a lot of assumptions in all of this, right? Like kind of both camps, or maybe there's like, three, four camps in this debate. It's all really unfalsifiable, right? It's just like kind of theoretical. And that's like kind of what makes it fun. But, this is assuming that a state actor has, or some actor has 51% of the physical ASICs, and a lot of people will point to pools and say, well, two pools have, all the hash power or 50% of the hash power, or, this X percent. And, that obviously I think is a little bit, not misinformed, but the wrong take because the ASICs aren't physically located there. They aren't physically domiciled there, but that's another topic. But let's just say hypothetically they get the ASICs, right? The US government goes to all these public miners, men with guns roll in and they say, okay, well, this is ours now. The threat model is, well, one of two things. One is like kind of the half baked threat attack is like, it's only white market Bitcoin transactions that are allowed in the, like maybe OFAC, non-compliant transactions, black market transactions, non-KYC transactions are censored, right? And any miner that mines those will get basically reorgs, or those will get kind of like stale orphan blocks, and the majority censored transaction or censored hash rate miner will continue to kind of mine that white market. And then the other one is, in a world where there's no block subsidy whatsoever, the miner will just mine completely empty blocks and basically DDoS attack the network is another, kind of like hypothetical threat model. And so for me, I guess the argument that the reason I went into essentially my argument in the video was saying that the difficulty adjustment is a self-correcting, self-reinforcing mechanism in Bitcoin, where, if it's, not profitable for miners to mine Bitcoin, they're going to temporarily unplug, blocks are going to slow down. There's going to be slower transaction finality. There's going to be a clog in the mempool queue. People are going to pay higher transactions fees to get into the next block. And oftentimes we see with these fee spikes that higher fees beget higher fees, right? Because there's like similar to like the ordinals BRC20 craze, where like not only were these BRC20 tokens paying all sorts of fees, but anybody that was like actually economically using Bitcoin just to send value, not like the ordinals thing, also paid massive amounts of fees. So, I mean, I didn't really go into this much depth in the video, which maybe was the cause of the controversy. But my thoughts on the matter is that in, these hypothetical threat scenarios, never mind the fact that I think actually ASICs will continue to decentralize as hash rate continues to go up, as hash price continues to go down in BTC and USD terms, most likely, as has been the trend for the entire history of the network, that ASICs will actually continue to decentralize, and that the block subsidy, one could argue that the block subsidy is maybe even a centralizing force in miners, and that you're not going to see these massive megawatt farms in a world where, the profit from mining Bitcoin, it's like basically scattered to the lowest, maybe even free cost of energy around the world, which is, I guess, another avenue to go off of. But my thought is that in a world, right, where there's no longer a block subsidy and it's just fees, you essentially there's like the idea of the aggregate security budget as a viewed is almost a flawed way to look at it. And individuals pay for their own security budget via fees, right? So if someone is censoring the network, right, and whether it's economic or not, maybe a state actor wouldn't be economic. Well, the people that would are being censored, whether it's everybody or just the black market transactors, are going to pay 10x, 100x, 1,000x the fee rate to get into the next block. And the whole idea of Bitcoin, the thing that like makes this work, the game theory of it is like economic incentives. And so if you like, if not you, but if someone thinks like, well, this isn't going to work, well, then I think that, you know, Bitcoin has been doomed to fail. I guess that's the argument, right? It's like, well, Bitcoin's always been doomed because the economic incentives won't prevail. And my opinion is that it will, right? And so like, even then, right, if you think that and you think, well, the people that are going to be censored won't be able to counter this with like a massive increase in fees they're paying, right? And the economic incentives won't prevail and cause more hash rate to come online to mine those black market transactions. Well, in that case, if you believe that, which, believe what you will, I don't believe that the 1 or 2% fee emission on top of that solves anything to begin with, right? Like, oh, well, these miners are going to be uneconomic. They're going to ignore this massive spike in fees from the black market actors. Great. Think that whether, it's just the state that has the money printer that doesn't care about the Bitcoin fees. Well, in that case, what does the 1 or 2% fee emission even solve? Right. So I gave you a whole bunch of stuff there. That's my kind of long-winded thoughts. And I have, more to go on if you want to dig deeper, but does that make sense or did I
Yeah.
just go on a random tangent?
No, I love that. I like the facial expressions there at the end too. And I think the fee emission thing,
What are
the
your thoughts?
2% thing that
What are your thoughts? I would love to
yeah,
hear
so
them.
we're obviously not gonna solve the fee emission problem here on this
We're going to solve it right
podcast
here.
here.
We are. We're going to get to the bottom of it.
Well, yeah. If you can open the terminal on my laptop, then that would itself be impressive. So, okay, let's break it down into like sections. The first part is like the emission schedule debate sort of centers around like short-term reorgs and long-term reorgs, or that's how I like to break it down. And yeah, we could get more nuance with it, but the short-term reorgs is like the tip of the chain. We're worried about like the first one, two, or three blocks constantly being reorged as like a pool or another mining entity on there wants to keep reorging the chain, so you can't like really settle a transaction. And then, like the longer term reorgs, right, is like, hey, let's go back 5, 6 blocks and just keep fundamentally changing the chain, or let's keep forcing people to build on a certain chain that doesn't include a lot of transactions. So you mentioned like the empty blocks. That could be one sort of longer term attack I like to think of. And then you also mentioned like a state attack where they're like forcing you to, they're censoring transactions that do not comply. So that's how I sort of break it down. I think the second version, like the longer attacks with 51% attacks, those are less likely. And I also don't think that like the fee situation really negates that issue because it's a much larger task, right? If someone was going to try to attempt that, they already have a ton of money and there's already something fundamentally broken. But the short-term reorgs is the thing that I think that's a little bit more interesting, right? And if we're relying on the fees to incentivize like the first one, two, three blocks at the tip of the chain to be processed correctly and for people to build on top of them, well, we might have some issues because fees actually might be too high or too low. And I think this kind of gets to like maybe the point of your argument here, which is we don't know what we don't know. And a lot of times the modeling around these things is just completely speculative, right? And so for right now, we don't have a rationale or a reason to say that Bitcoin's model is wrong. We have some papers out there. I think Hasu and James Presswich issued something in 2019 that was really interesting around like how Bitcoin it might have potential MEV in the future. That's a really important paper. There's been some other talks about this. Ethereum people obviously have been working on this a lot because they're bought into the idea that the security budget is an issue.
Yep.
But right now we don't know what we don't know. But I'd be curious what you think about like that tip of the chain issue, right? Where we're like we might have issues with short-term reorgs because we're relying on a world where there's just fees and there's no Coinbase subsidy. Do you think there could be an issue there in say like 20, 30 years?
Yeah, I mean, this is like another kind of avenue of the debate, but and
Yeah,
again, this is, really like this entire thing is speculative. Like even the notion of like security budget being too low or too high is like, well, okay, what's the threshold? And there is none, right? It's just like like the the I guess like what some people would say, the laser-eyed maximalist crowd, which is like I don't like to be kind of grouped into, or like, siloed
you
into
do
one
have
avenue of
laser
thinking.
eyes on
I
Twitter,
do. So I guess
so
I'm a laser-eyed, maximalist that hasn't thought about this stuff. But I guess like when I think of Bitcoin in 2023, even, like for 14 years post launch, it's like a bet on Bitcoin, even, heading into the fourth halving is still just a bet on Bitcoin's monetization. Right. And so like,
yeah,
the Ethereum people would say, well, yeah, no one's using the, the chain and like, or not just the Ethereum people, but the people in like the security budget concern side is like,
yeah,
and, okay, let's extrapolate this out. And then, miners are getting like, X million dollars in the future. And there's no way a $1 trillion network can sustain itself at that. And my sort of thing is like, well, I think this is just like part of the monetization arc of Bitcoin. And like, if you extrapolate it out in 2011, what the fee model would look like, or 2014, or 2017, or 2020, or 2023, like it looks different every single time. And so, like even like the people that were, that are championing like the concern right now, like we're making fun of Taproot in 2021, and now like
yeah,
Taproot's the next best thing, and like ordinals are going to save the security model. So like it's the like I guess my argument, or maybe even lack thereof, is like it's an unknown, and like concern trolling about like, oh, like Bitcoin's doomed or it's gonna need fees or whatever, and like saying like almost like a neo Keynesian, like we need 2% inflation to, and like that will
yeah,
be the solution. And then it's like, well, and this was part of like the block or the fork wars debate in 2017 is like the people that were saying no to SegWit 2x were saying like, no, this opens up a can of worms. Like, of like, oh, but this fork actually makes it better. And so it's like, oh,
yeah,
well, 21 million Bitcoin. No, that's Bitcoin will actually, have an issue and a perpetual issue. It's like Dogecoin or something. And that will be like the solution to our issues. And it's like, well, that's your idea or that's your like opinion. Right. And so
yeah,
like, again, this is literally all hypothetical. I guess the camps are like, do nothing, fork, hard fork, emissions, perpetual, whatever. And the third kind of like maybe like second B camp is like, we just have to like maximize block space usage, which I agree with. And my opinion is like, yeah, that's going to come anyway. If you believe that this
yeah,
thing is going to monetize and isn't just going to, like, if Bitcoin just stagnates forever right here, then like the current amount of energy usage and mining, security, if you will, is fine where it is. And if Bitcoin is going to, 10x, 100x, well, there's 100x basically wasted energy in the world that's not being monetized right now. So like, and
yeah,
that could be monetized at like basically zero cost. And the race for that like profit or that revenue is like literally going to be racing to zero. Like the idea that, we're going to have like these like 1 billion megawatt mining farms on a grid in 30 years is like wrong, in my opinion. It's going to be like,
yeah,
and again, that's just my opinion, but it's like you're gonna have, flared methane that's gonna be combusted in mining Bitcoin. You're gonna have Bitcoin, in Africa on like a, makeshift dam that's being mined. And like
yeah,
and so just like kind of like, quantifying this stuff and modeling it. And it's like feels very like Keynesian to me. And my whole
hmm
argument was just like literally mansplaining. Eric was like, "You're mansplaining the difficulty adjustment." And I responded, "Yeah, exactly." Was just like, it's a self-correcting mechanism and
yeah.
I'm not too worried. So maybe that's naive. Maybe I'm just, haven't looked into it enough or something, but that's my
A
take.
brain dead laser eye. Yeah, no, one thing I wanted to jump into there is talking about like the difficulty adjustment, which basically like your whole video is like premise on that, right? So as the network increases, people are going to use it more, but as like mining becomes harder, people will drop off a network in terms of mining, and that'll lead to like fee pressurization as like there's slower block times and people still want to use the network and we'll come back to like an equilibrium, which I do think is like a very fair market argument. The question that was pushed against you, and I think you someone answered this, but 1% attack comes as you start lowering the difficulty, right? As like difficulty drops 25%, 50%, as all these miners start to leave. And that's where there could be some pain points. And we've seen some arguments around that. Justin Drake, who's an Ethereum Foundation guy, is we've had him on this show too, talk about this, where if you were a state actor who wanted to attack the chain, you would wait until the worst bear market mining time ever, right? You'd wait until difficulty just lowers a lot, and then you're able to pick up cheap basics. So I think like there is an argument there. What are your thoughts on that? Like that moment where there could be like a 51% attack and put the network in jeopardy?
Yeah. So how I'm thinking about it is if there's this sort of 51% attack, whether it's like just a straight up DDoS of no transactions or, orphaning off any, you know, Bitcoin blocks with, non KYC sort of blacklist transactions in it, is that this fork off or this 51% attack where, that malicious actor is consistently mining their own blocks or, continuing to rewrite the chain, that's going to also send hash rate a lot lower because none of the non-malicious actors blocks are being mined. Right. So all of a sudden, this actor is, 51% mining, and then the other one, the good actor, if you will, isn't, which was going to send difficulty a whole lot lower anyway. Meanwhile, in theory, the transactions in the mempool from like the black market fees are going to literally be skyrocketing and just continuing to build and build and build and build and build. And that, in my argument, only went surface level, as in like, oh well, when blocks slow down, fees are going to build up. But I didn't even dive into like, well, if there's like an actively known malicious attacker that's censoring transactions, it's not even just going to be a buildup. You're going to see fees absolutely soar. And at the same time, difficulty is going to have to just plummet because, say like, 50% of blocks or the hash rate's only basically 50% of what it should be because of that malicious actors continuing to rewrite the chain, rewrite the chain, rewrite the chain. And so, my response is like, well, it's going to be a market correcting mechanism where that honest hash rate is going to have the massive incentive to mine the blocks, and two, the difficulty is going to drop tremendously. And there's all this old gen equipment out there, right? Like if you believe Moore's law, and maybe it tapers off, maybe it doesn't, which is another kind of twist to this whole argument of like, well, yeah, maybe they do have 50% of the hash rate now, but like, the next gen of ASICs is going to be even faster, which is like another one of these like unknown unknowns that nobody can factor into all of this. Well, when difficulty adjusts lower and there's this, massive monstrosity of a mempool with all of these fees that we've never seen before because of just, how blatant the censorship regime is, there's just, this natural market-based incentive to be honest. And so like if the argument is like, well, there's not, that economic incentive and the game theory of all this and the profit incentive like isn't enough. Like, I guess that's your argument. My argument is that like, no, the economic incentives will prevail. And even if there is, temporary reorg, you know, for some time, well, it'll be a naturally correcting mechanism. And over the long run, I guess maybe if it's funded with a state money printer or whatnot, but over the
Yeah.
long run, the honest actors are going to benefit getting paid in Bitcoin. And, that will result in them obviously, you know, getting more profit or more revenue. I guess the other take is like, and I don't really know how I feel about this because it's not really like the ethos of Bitcoin, but like I guess maybe Andreas's take. There's that really like that old video of him talking about like what would happen if someone 51% attacked Bitcoin, and he's like, oh well, we would identify them and then we'd fork off and just kind of go to the last block that before the censorship, and they'd have mined a bunch of worthless blocks and wasted all this money, and they could have just made Bitcoins. And so I guess that also is an argument where like, the good actors and everybody could be like, well, let's go to, 5 blocks back or, block tip,
Yeah.
XYZ. And, we'll kind of all just agree. And the market, similar to like how a fork works, like Bcash, Bitcoin, it's like, well, the market decides that this is the valuable chain. I guess that's also an argument, which is like, I guess goes against the ethos of like, well, the longest chain is the chain.
Yeah.
But bunch of different avenues to go
Yeah.
down.
Yeah, definitely. And so let's leave it here so we don't beat it to death. Thanks for all the explanation. What do you think about like the reaction to your tweet? Because I think we're like in the depths of a bear market and people are really bored and people are like pretty nasty online. And I was kind of surprising to see this pop off because like we talk about security budget forever, right? Like it's almost a boring topic at this point because it just keeps coming back around. But your tweet kind of hit the right people in the right way. And I'm curious like why you think that actually happened.
I mean, yeah, it's a heated debate. I had my fair share of hot takes and back and forth with like the maximalists and like the crypto agnostic, like multi-chain people. I mean,
Yeah.
I don't care. Like it's the arena of ideas. Like roast me. It's like
Yeah.
I'm not gonna whimper or hide away or whatnot. I honestly I posted it. It was my last tweet of the night. I logged off, put on do not disturb, and then went to dinner and came back. And then this morning logged on and was like, oh wow.
Oh shoot.
So yeah, no, it's like I mean, it's great. I think discussion's great. I'm willing to defend my ideas, and if it's wrong, let's talk about it. I mean, I don't think it is. I just think the
Yeah.
notion of like, oh, this is a problem, and I have a centrally planned solution.
Solution.
It's like, yeah, do you though? So yeah, let's talk about it. Roast me, agree with me. Like it was kind of funny. It was like either like genius or like you're a fucking moron, and there was literally no in
Yeah.
between, which is great. Like I love it. But
I'm
yeah, I
trying to
mean,
give you the centrist position here on the show.
yeah, I appreciate it.
Trying to do that for you. Yeah, no, like just to respond to that really quickly. I think the thing that irks non-laser-eyed folks is the certainty of laser-eyed folks of like how like they're certain that Bitcoin doesn't need any change in security budget or doesn't need any change from what it is right now. And on the flip side, right, we have like the whole you're trying to make Bitcoin a shit coin, you're trying to change things. And I would love to see more of like the centrist position where it's like, hey, let's just like have a conversation around what this means. But I think that is always ruined because someone comes with some sort of solution. So like Peter Todd comes with like this 2% inflation solution and he has like a whole thing around it, right? Where he's like, we could take old coins that haven't moved
Yeah.
in a while and reprogram those. But I always think that that kind of ruins the conversation, right? Because like someone comes with a solution and all of a sudden that solution is the focus instead of like the intended argument of there being a problem.
Yeah.
Uh,
No, I mean,
yeah.
I think I'm more in that camp than like maybe my tweet or like my profile picture would lead to believe. In the sense that, like, no, there's a bunch of unknown unknowns, and anybody that speaks with, like, absolute certainty of, like, for me, I'm like, "Okay, tell me what the right security budget is," or, like, "Tell me where fees will be," or, it's like, "Oh,
Yeah.
okay, I'm gonna assume the market cap, and I'm gonna assume the fees and BTC terms, and I'm gonna assume the hash rate and the difficulty, and I'm gonna also assume that ASICs aren't gonna be geographically distributed, or they are." And it's like
Yeah.
and then it's like, "Oh, with all that said, I have a solution and also a certain fix to this problem." And it's like, no, my solution is like, I don't know, but we have the closest thing to like a correction mechanism, a self-reinforcing mechanism that is the difficulty adjustment and a free market solution. So, Bitcoin
Yeah.
doesn't monetize and no one used Bitcoin like what Satoshi said, essentially. And not that he's like some god, but he's like, if no one's using it's like either a whole bunch of people are using Bitcoin in 20 years or I forget if he said 10 or 20, or they're not.
Yeah.
And if no one's using Bitcoin on chain in 20 years from now, then like something went wrong. And, I guess
Yeah.
that's like, that's my stance on it.
Cool. Okay, let's move over to Riga. You were there last week and you gave an awesome presentation about macro cycles and flows into Bitcoin. I think the correct framing or summary of your talk was we have this 4-year cycle with Bitcoin. It's proven out pretty consistently. And a lot of people have thought of it in terms of halvening. And then you model it according to like M2 money flows for like world M2. Walk us through that a little bit, and then we're going to move over to like how that plays into Bitcoin mining. Certainly, a lot of people listening to the show are interested about how like once Bitcoin capitalizes, the mining side of things will rebound. Maybe we can even get some hopium for Bitcoin miners right now who are not doing so hot.
Yeah. No, I used to be like much more of a having, like when I kind of first went into Bitcoin, it was like a having, kind of drives everything. The stock to flow model was like rather intuitive. It wasn't gospel, but it was just like something cool to visualize. Increasingly, as I've like studied the protocol, I think it's much, much less. I mean, and obviously with each halving, the role it plays diminishes. But in my opinion, right now, like I think at least going forward, like the halving from like a price action standpoint is more of like, paradoxically is more of like a demand driver than a supply driver in the sense that like, yeah, supply, margin at the margin diminishes a bit and, those flows do add up. But really, if you kind of like, check the chain TM, there's much more coins flowing back and forth, flooding onto exchanges, coming off from exchanges, the interplay between like, long-term holders, the coins that don't get spent, and like probabilistically, the longer they're held, the less likely they are to get spent versus the coins that are just continuing to change hands, that kind of like free float. Like that's what's driving the actual cycles. It's like the interplay of like, okay, this supply is extremely constrained. Money flows in. Bitcoin seemingly like randomly so to the outside observer goes parabolic. You know, pa- Part of that is driven by the macro side. Even when Bitcoin was smaller, just kind of like the kind of the flows of the business cycle, in my opinion, and risk on, risk off, and increasingly so as Bitcoin becomes larger and more ingrained in the global balance sheet. But paradoxically so, or maybe like in the earlier cycles, it was a bit much bigger driver. It lined very well up, very nicely with the halving. So like the narrative is like having number go up. And like, I think who knows, like Bitcoin could very well, pump this time around, ETF, other side of a recession, maybe like money printer. There's all these other, conflicting narratives. But like to think that like we have all of this data out there, we have an entire UTXO set to analyze. Bitcoin is increasingly becoming interconnected and correlated with equities and bonds and volatility and the dollar. And it's like, oh yeah, this like supply issuance, this like change in the code just like switches and Bitcoin just like programmed to go up, I think is like a very simplistic way to look at it. So yeah, I mean, I think like the macro correlation, one of the main points of my talk was like, from some of the like hyper maximalist people, it's like, screw the BlackRock and the financialization of Bitcoin, like, screw the suits. This is bad. The financialization is bad. And my argument is like, yeah, I mean, if you want to think that, great, but Bitcoin's permissionless. And the way that Bitcoin goes from a $500 billion drop in the bucket, nothing asset, not nothing, right? 500 billion significant, but the way that like, how to reach where a lot of these Bitcoiners like think, even like the far, far like right side of like the distribution curve of like outcomes of like hyper Bitcoinization, like, well, how does that happen? Right. It's like these guys, these boomers with like trillions upon trillions of capital coming in, and they're not going to like buy on Coinbase and then send it to their multi-sig wallet and then coin join. Like they're just going to buy Larry Fink's ETF. And so like I guess that was my like argument of it is like, this isn't a bad thing. This is like how TradFi, at least initially, is going to come in. And like, it's, in my opinion, should be embraced, right? Like you can still do like the cypherpunk kind of like Bitcoin native maximalist sort of things. But like this is how the quote unquote suits are going to access Bitcoin.
Yeah, definitely. So when I listen to that talk, the first thing that came to my mind is like, we do have exposure ways for the suits right as of now, or like mom and dad's 401ks to get exposure to Bitcoin. And that's oftentimes through Bitcoin mining stocks, which right now is like a market cap of like $8 billion, give or take.
Yeah.
And that can inflate like rapidly. So I think Marathon Digital's market cap is like 2 billion right now. And that's pretty small compared to where it was the top of last cycle. I think it was 8 billion itself last November 2021. And that was with less shares outstanding by a significant margin.
Yep.
So I'd be curious to how you think about that. Like, where are these like mining stocks going to go? To me, it seems like obviously not financial advice, and I have to throw in that like infamous cringy line. But I think that's where a lot of these flows are going to go. Be curious for your like thoughts on how that plays out.
Yeah. No, I think Bitcoin miners, just given the lack of or like, the kind of the illiquidity of the market caps. I mean, it's really hard I mean, $8 billion is nothing, right? Like it's hard to put, it's hard to move $50 million into these things. And also, I guess just one narrative that I like kind of want to like nip in the bud before we dig into it is like, I see all the time, and I've commented on it a little bit, but it's like, BlackRock is accumulating. And it's like, guys, BlackRock passively indexes into every company on the Nasdaq and S&P 500. So them buying a marathon or, you know, go down the list is just them like passively buying on behalf of their Nasdaq ETF clients, or maybe like, they have other, ETF buckets, but BlackRock is not like actively preparing for the halving and like loading up, right? It's just they're doing on behalf of clients to collect fees. So to dig into it a bit more, I think Bitcoin
Yeah.
miners obviously like, hyper volatile. And if you just look at like how they trade and you put like just account for the realized volatility of these things, the Sharp ratio is essentially, I mean, it depends a bit on where they are in the cycle, but we have a limited data set, but Sharp ratio is basically in tandem with Bitcoin. So what does that mean? The fact that like in a bull market, they go up, last bull market, they went up like some of them 50x, even more. It's like, well, these things are just levered Bitcoin to the hilt, right? It's just like, and they are, right? They're levered on their balance sheet. They have liabilities. The ASICs are also, you know, essentially an expression of Bitcoin's price. Some of them took on like ASIC collateralized loans, all of this. So like they do trade like, levered Bitcoin, and that's why in a bull market they get killed. I do think like in the next bull market, whenever it may be, or really in any bull market, in a hash price bull market, when miner revenue per terahash or per unit of hash rate is increasing, you want to own the miners. And obviously that's completely dependent on the Bitcoin price, and that trends lower over time. But, you know, when in a bull market, or especially, like coming out of a bear, these just a small change in the Bitcoin price can massively expand the margins on these miners. So like I think honestly, from like a security budget debate, talk about like how public miners business models will change, or if it'll even be like a viable thing of like, this centralized massive, you know, owner of hash rate, in one place or a few different facilities. Like that's, almost not more of an interesting debate, but like you can maybe like think about the viability of five, four halvings from now, three halvings from now, five from now. Like, will these massive conglomerate miners be a thing, or will it be much, much more decentralized at scale? But I think at least, for the coming cycle or two, I want to own a bunch of them. I've like entered tiny, tiny starter positions on some of these names, but I still think we kind of got a recession ahead of us in 2024. So not all in just yet.
Dang, I want a little more hope. You said you debunked the halving, and then you also said we're going to recession. So that's a little freaky there for mining friends out there. What do you think about like the concentration of some of these mining stocks? The one thing that was interesting to me is seeing like the lack of miners going public after 2022. I think the only one that's really been able to like get through since Core Scientific was BitDeer, and they went public earlier this year, and they had already done a lot of the applications prior, right? They had teamed up with a group called like Safari Blue or something like that, some SPAC deal, and so they were able to get it through after like a lot of delays. But it does seem like a lot of the capital's been concentrated between like a few market leaders, like your Marathon Digitals and Riots of the world. What and at the same time, we have some of these other people kind of popping up, like Clean Sparks and others, and Iris Energy. I think you should throw in there too. Any thoughts on how that's working, or anything from like the research team that you've been working on, looking into how these mining stocks are operating like in the public space? Because it does seem like the mind share, if you will, is really focused on like two or three miners out there.
Yeah, I mean, I think some of the smaller names are pretty interesting, just from like kind of a trading perspective. The liquidity is very, very much concentrated into the riots and marathons of the world. Like also they kind of are like a fan favorite in some of like the Wall Street bet circles, and have like, much more like liquid option chains, which is another kind of debate. They're also like frequent just because of their size and relative liquidity compared to the rest. They're also like, kind of with Coinbase favorites from like the short baskets for some of the, kind of like the hyper volatile public names, not just in crypto, but kind of in like tech broadly, if you want to think of it like that. So, I mean, I think I think it's fine. It's nothing to worry about. There'll probably be some smaller names just because of liquidity and just because of, probably mispriced valuations that, go bonkers and outperform the bigger names. in the bull. But, some of these miners, right? Like for instance, a Clean Spark, a Marathon as well, have, despite their share price, like, you look at the chart, pull it up in linear terms, it doesn't look great. Have done a fantastic job of like using public markets to their advantage with, share dilution, which obviously isn't great for shareholders in the short term. But if they can, build out a pretty solid fleet, an operational fleet of ASICs to prime for the bull market, then, good for them and they have every right to do so. And so, like if you just look at the market cap of like a Marathon and then you look at like the share price, the chart of the market cap looks a lot better, right? Which is because of that share dilution. And so, yeah, I'm really, I guess one of the things I'm interested to see is, if this time will be different from a cycle perspective with all these miners and, do they load up on loans and Bitcoin collateralized loans and ASIC collateralized loans at the top again or into the top, or do the kind of the risk management regimes get a little bit more prudent. So we'll have to see, but I think there's some interesting vehicles out there to hedge this risk next time. Hash rate derivative products, Luxor, Block Green, those sort of things.
Definitely. Okay, let's finish up talking about some network metrics. So right now it's pretty bad from a hash price perspective. We're at lows of like about 0.06 cents, and then in terms of like total network hash rate, we're like over 400 exahash. From your purview as like an asset manager or someone who's like in that line of work, what kind of metrics do you look at, and what are some things that are like either bullish or bearish for looking into mining stocks or just miners in general?
Yeah, I mean, this is a boring answer, but hash price is or the drift of the direction, the trend of hash price is I think one of the most simple but effective metrics for kind of looking at where or how miners are trading. Obviously, the main input besides hash rate in that is price. And because of, hash rate's long-term drift going up because of, increasing ASIC efficiency, as well as, increasing economic incentive. But, as these ASIC, because of Moore's law, become more efficient, these semiconductors become better and better, hash rate continues to just go up and up and up in exponential fashion. I guess it's actually tapered off a bit from like the, 2013, 14 era. But so, in that case, you look at hash price in Bitcoin terms or dollar terms, it's always near all time lows unless it's a bull market. I think one of the interesting metrics to look at is, and we only have about, 2 cycles, maybe even a cycle and a half for a lot of these miners, is you just look at hash price increase from all time lows. So, and like, it's the opposite of like, the usual kind of metric for a lot of different kind of financial stuff of like drawdown from all time highs. Well, hash price, it's like bounce from all time lows. And if you just look at the bounce from all time lows and then like these miners' performance, it's like, kind of, you basically see the manifestation of these like massive bull cycles. And with that, it's basically timing the Bitcoin market, right? So it's like, but the interesting thing here is once the bull market happens, once all of these miners go bonkers, we see a fairly common pattern, and it's pretty intuitive, where regardless of what price does, right? Price goes up, down, sideways, and usually after price goes parabolic, we see a bust. But regardless of that happening, because of this massive increase in the price of Bitcoin and the massive increase in these mining stocks and the massive increase in incentive to mine Bitcoin, you see like a 1 to 2.5 year lag of like a metric ton of hash rate come online. And so I think that's where a lot of these miners, some of them will outpace the growth, the network growth in hash rate, and some of them won't. But aside from like the Bitcoin price drawing down, that's where like, a lot of these kind of like weaker miners get wrecked, right? Is that, they don't actually outpace, whether it's because of, mistimed purchases or treasury management, they don't outpace the growth in hash rate. And then, along with like the Bitcoin native revenue, along kind of going back to our security budget debate, the Bitcoin native revenue going down, right, with each halving until a certain point, likely, but at least, for the interim, these miners get wrecked because they don't keep up with the hash rate. Their Bitcoin denominated revenue, each halving cycle goes down. Their dollar revenue, if the price of Bitcoin busts 70%, gets wrecked too. So, I mean, I'm looking forward to playing like this bull cycle in a lot of these names. And, I hate to say it, but I'm also looking forward to, as dangerous as it is to play the short leg a bit after, because I think honestly, I'm expecting a massive bubble in these miners. Like, Bitcoin has its bubble cycle, and we're all pretty familiar with
Yeah.
that. But I think just we're gonna see some crazy reflexivity and narratives and kind of mainstream media buzz in some of these minor names. And like there will be, just like there always kind of is, but there will be some, definitely some, like, thoughts or ideas of is this a new paradigm? Like, these miners are money printers, and they're gonna some of these maybe newer names, maybe there's another new IPO cycle. They're gonna get
Yeah.
they're gonna get leveraged up, and there's gonna, they're gonna draw down 80-90% again. And that's probably a few years out, but just kinda how I think about it.
So just to like clarify there, or maybe get some more info, you think it could be bigger than last cycle? Because like Core Scientific was pretty impressive, right? It kind of speaks to what you're saying there, like leverage to really leveraged and then went up and went down really hard and fast. So you thinking that there's going to be more money coming in next cycle because you're just thinking there's going to be more institutions next cycle and they're going to want to deploy capital into mining?
Yeah, I mean, there's been talk for a while, it hasn't really manifested, at least, on the margins it has, but there's been talk about, like, the energy producers kind of getting involved in a bigger way. Maybe, like, some people thought in the
Yeah.
bear market we'd see some, like, mergers, acquisitions. We really didn't see that all that much. It's more been kind of like on the private side, it's like, oh, Exxon, they don't really talk about it, but they're mining Bitcoin, with like their flared methane, but they don't even keep the Bitcoin. They just sell it and take the dollars. And it's like nothing to them, right? It's like not even worth mentioning because they print billions upon billions of dollars a quarter. So like, I do think the bubble will be bigger. There's obviously going to be more names, and some will, crazy outperform and some won't. But, regardless of the timeline, like people think that, the 2024 timing Bitcoin cycle is an absolute lock. Like I'm not saying it's not going to happen. I just don't think it's a certainty. But regardless, Bitcoin's naturally very cyclical. The supply is more primed than, it's ever been as a percent of its outstanding supply. Just in terms of, like, the Bitcoin being held, right? Like 95% of Bitcoin didn't move in the last month. That's never happened
Yeah.
forever. So like supply is extremely inelastic. It's just a matter of if you have flows. And right now, like, just being straight up, there's no flows. There's no buy side flows
Yeah.
into Bitcoin. I mean, there's some, right? Like the sat stackers, like I know, but like the institutional capital, like the talks of like, oh, well, like front run the ETF. Well, everybody that's like talking about front running the ETF, and like the people on Bitcoin Twitter or crypto Twitter, like they're mostly deployed. Like just, being straight
Yeah.
up, like the people that are like hyper bullish Bitcoin, like they're not sitting in 95% cash. They're sitting like aggressively, however, their aggressive allocation to Bitcoin is, they're positioned, right? So like there's no one front running ETF flows or, potential ETF flows. Those flows will be the, I guess front running of sorts. It's not priced
Yeah.
in if and when it comes. And I actually don't even think if an ETF, when an ETF is approved, it's not like an absolute guaranteed lock that immediately buy, $10 billion of Bitcoin right away. Like that's very much interdependent on how bad the business cycle is, whether we get a recession, right? Like if NASDAQ is dumping and everything's risk off and the dollar's soaring, like, you know, the flows into Bitcoin aren't going to be all that strong, at least temporarily, right?
Yeah.
And like there's a natural cycle there, but I think these are some of the narratives that, maybe get people a little bit caught off sides in 2024. Maybe not, but I'm pretty certain, very certain that regardless of the timeline, this natural kind of bubble phase will happen again. And at that point, I want to be aggressively long the miners.
Wow. We got a bear on the show, but I like your long term thesis. Dylan, thanks so much for joining the show. I don't know if you have any. I think everyone probably follows you already on Twitter, so we don't have to shill that. But like anything in the future that we should be paying attention to, or something coming up in the near future.
Yeah, just follow me on Twitter. Maybe catch my next 3-minute video series or something. Well, looking forward to that. But no, I appreciate you having me on. It was good to kind of go back and forth on some of this more in the weeds kind of debate. Probably good to get my more than 3-minute long view on things out there as well. So I'll be sharing this.
Yeah, we'll have to get a debate with you, Nick, and Udi or Eric on here next time. But maybe. Cool. Thanks, Dylan.
Cheers, man.
Peace.